How to think about your federal employee group life insurance coverage. Is this good insurance? Is it expensive? Is it a good fit for your financial plan? Want to talk through how the program works a little bit today, as well as how to think about it within your financial plan. Now, first of all, Fegli is neither good nor bad. It's simply a tool within your financial plan. It's group term life insurance that's available to all employees, to all federal employees, and you're automatically enrolled as a new hire. You actually have to opt out of coverage or waive coverage to get out of the policy if you don't want the coverage. You're automatically enrolled in the basic option, which is 1 times your annual rate of basic pay, rounded up to the next $1,000 plus $2,000. And that premium, 1/3 of it's paid by the agency, 2/3 paid by the employee, is the same for all employees. So 25-year-old new hire, 60-year-old getting ready to retire, pay the exact same premium. Comes out to be around 35 cents a month per 1,000 of death benefit, okay? So you can see expensive on one end, cheap on the other, depending on which end of that spectrum you're on. There are also 3 additional coverages you can add on. Option A is a standard $10,000 death benefit. Option B is the multiple, so you can add 1, 2, 3, 4, or 5 times your annual rate of basic pay as additional death benefit on your life. And option C is family coverage, so you can add coverage on a spouse or a dependent. Do multiples there as well, $5,000 increments on a spouse, $2,500 increments on a dependent. The optional coverages are all age banded. That means as you get older, the price increases. Age bands last generally around 5 years. It starts to get super pricey as you get into your later 40s and your 50s. People come to us and say, what am I paying for? Could I do better than this? That's typically when it happens. So there are some good things about Fegli. First of all, you have coverage right away, no underwriting. And you can add, so you can have up to 6 times your annual rate of basic pay as death benefit. I think that's a good thing. Have that coverage in place, protect your family. And of course, if you're not insurable, having this coverage in place, a really big benefit. What we don't like about the policy, well, it's controlled by your employer. So there's a little less freedom, flexibility. There's some questions what happens if you leave your job early. And of course, the age bands. We really don't like the age bands because things get expensive. We like consistency in what we're paying for. Which brings us to, is this expensive? I'll say this, if you have a good health profile, you probably can find something cheaper on the open market depending on what term you're looking for, right? If you're just looking for some term life coverage and you have that good health profile, you can probably find something cheaper on the open market. If you're looking for something permanent, that type of insurance is almost always going to be more expensive. And that brings us to, is it a good fit, right? So it just depends. You need to determine how much insurance your situation calls for. What are your goals for that insurance? Is it income replacement? Is it funding a major goal like education expense for a kid? Is it protecting an asset like a mortgage? Determine how much coverage you need. If it's income replacement, you probably need more than 6 times your annual rate of pay, because if you're taking a safe withdrawal rate, it just lends itself to needing a higher amount of principal to do that. But if you're just looking to fund a goal or pay off a debt, you could likely get there with 5 or 6 times. Then you also need to think about, is term coverage right for you? So are you looking to just protect your family during that time when you're most susceptible, that 20 years when you're raising your family, maybe a little bit of time after that? It just depends on what you're looking to do there. Versus something more permanent, are you looking for estate planning solutions, et cetera, where you need something that's going to be in place for the long term? The second question to that is, what happens if you leave your employer, right? So you have this coverage in place, but things change. Do you want the consistency of having something locked in that you're in control of? Or are you okay with there being a little uncertainty from that standpoint? And as I mentioned, if you're uninsurable, this is a great option. So if you are considering making any changes, avoid this one pitfall. This is big. Do not cancel any coverage until you have your new policy in place. Insurance companies are notorious for this. You think everything is going smoothly, you cancel your existing policy. The other one's not locked in yet. All of a sudden, they decide you're uninsurable. Now you don't have coverage. So you want to make sure everything is in place before you go ahead and make that change. So I hope you found this useful. A little bit of information here on Fegli, how it works. If you have additional questions, please feel free to reach out and we'll try to point you in the right direction.